Welcome to Apella Academy's continuing education webinar series. My name is Jim Tavares, and this is Completing the Financial Plan with Life Insurance, brought to you by Apella Capital. This is, I think, our 9th webinar, but some of you may be joining us for the first time. Here at Apella, when we aren't working on financial plans, we're educating our clients on financial literacy. We want you to know as much about financial planning as we do. And that's really the goal with the Apella Academy webinar series. Our clients depend on us to help them make long-term financial decisions, and many times that may include some type of life insurance solution. After all, you can't plan for your life if you do not plan for your death. Our team of advisors has decades of experience providing investment and life insurance solutions. I myself came to Apella with 10 years of life insurance experience, so I'm happy to be presenting this topic to all of you today. We will have a Q&A session at the end, and I will try to answer all of your questions at that time. But feel free to go ahead and type into the message box as we go along. Completing the financial plan with life insurance. And we're going to talk about 3 main topics. Common life insurance scenarios, and this is going to be the area that we know very well about life insurance, providing coverage in the event of an early death. Common policy types, the main ones that we will discuss, and leveraging life insurance, and this is strategic life insurance. Okay, who needs life insurance? What are you replacing? And how much is enough? Again, so in this scenario, when we're discussing this, we're thinking about people that have basic needs for life insurance. And we'll review each of these categories in terms of how much they have to replace and how much is going to be enough, which is very common. In the common policy types, we're only going to discuss 3 types of insurance: group term insurance, individual term insurance, and permanent insurance. And lastly, the strategic life insurance, leveraging life insurance with charitable gifting, estate planning, and generational planning. So who has life insurance and who needs it? 65% of Americans say they need life insurance. 1 in 3 households would have immediate trouble paying their living expenses if they were to lose their primary wage earner. 132 million Americans relied on life insurance to protect their financial security in 2015. In that same year, the U.S. population estimate was 322 million. So in terms of people that need life insurance, it's really to replace your financial responsibilities. And if you've got a family, you've got dependents. So they're depending on your income. So it's safe to say you have to plan for 20, 30 years or even more when you're thinking about how much insurance somebody needs. And it doesn't stop at basic expenses or large expenses. We're talking about new and unforeseen examples as well. So let's say, for example, that you are a primary breadwinner, and say that you've got a spouse and you've got family, you've got kids. And if it's for me, and I've got insurance, and let's say, for example, my wife stays at home and she doesn't have insurance, she relies on my insurance, my medical insurance, let's say. So if I die, not only do we have to talk about the income that she would have to replace, but also now she has to purchase additional insurance. In addition to that, if she was home that whole time taking care of the kids, now she also has to we have to have an additional expense to take care of the kids, childcare expenses, her change of lifestyle. So those are all things that happen as a result of the death that we obviously didn't, we may have planned for the expenses, but we don't think about the additional things that happen afterwards. They all add to additional unforeseen expenses. Now, another thing I want to talk about just right now, but we won't get into too much of it, is about business expense, and particularly small businesses and perhaps partnerships. Let's say, for example, there's a small business, there's 2 partners, and one passes away. Now, the next of kin, let's say a spouse, they would inherit that business. So now you would be in business with your ex-partner's spouse. So if they don't know as much about the business as your partner did, it stands to reason you could have some trouble there. So one of the things that you can do is create what's called a buy-sell agreement, and life insurance is how you carry that out. If your partner dies or you die, either one, then the death benefit will then pay for the other half of the business. So then you become a sole proprietor. Another situation to keep in mind is a person that is pivotal to the business action. So that would be called a key employee. So if this person passes away, the business nearly ceases. So you would have to, not only the business would suffer with that person dying, but perhaps the amount of time that it takes to train that person would be an enormous expense. So again, a key employee and a buy-sell agreement are two types of safeguards that life insurance will help in business. And that's all we're going to talk about business today. So how much is enough? This is probably the biggest question that people ask. How much life insurance do I really need? Well, some experts say that the best way to calculate it, or the easiest way to calculate, I should say, is 10 to 20 times your annual salary. And that's simple enough to do. But if you want to get very specific about it, and particularly how a life insurance professional would do it, you do what's called a life needs analysis. So this is going to break down more specifically the large expenses first, and then the living expenses second. So big expenses like your funeral, credit cards and car loans, mortgage, college tuition, if there are college plans, either for children or for your previous college loans. And then the living expenses. So this is everyday expenses: food and clothing, rent, utilities, taxes, internet, phone, and cable, because we can't do without that, childcare and school activities, as I previously mentioned, and any other additional expenses that could arise. So the basic types of life insurance really can be broken down to two categories, folks. There's term insurance and there's permanent insurance. And then there's a whole bunch of different categories after that. But for today, we're just going to focus on those two. And in term insurance, we're going to speak about group term insurance and individual term insurance. And on the permanent life side, we're going to talk about traditional whole life and a little bit of universal life. So on group term insurance, this is the most common. Generally, you get it through work, and the coverage is about 1 times your salary. That's where it starts at. It could be higher, 2 times, 3 times, 5 times. It really depends on whatever your employer package is going to offer to you. Really easy to apply. You just have to check a few boxes, and it's payroll deducted, so it's not even a bill you're going to see. So you don't mind paying it, and you always know that you have it. It's typically the lowest cost, but it increases with age. And they usually do that by groups of 5 years. So you start, and when you reach your next bracket of age, so 25, 30, 35, there's an increase in the premium for you. Now, it's usually not mobile, so that's really important. So if you change employers, you will lose the policy. And you may have gotten comfortable with the fact that you've got insurance through work. And let's say you started at one point in your career, and as your career advances, let's say that you've gotten married, you've got a family now, and down the road, now you're ready to leave, take a new opportunity, and now you're older. You may not be as healthy, but you have more need now than you did before. So now you're going to be paying a lot more money for that insurance. And you have to keep in mind that the insurance that you had, you won't be able to keep unless that employer's policy says that it's mobile. Now, the one thing you could do to safeguard against that is being in control of your own destiny, and that is by having your own policy. So that's where individual term insurance comes into play. You get your most bang for your buck here, and what I mean by that is that you don't have to pay a lot of premium to get a lot of death benefit. There's many choices for the number of years you can get. 5 years, 10, 20, 25, 30, whatever the company that you're choosing from is going to have different choices. Now, you may say, why do I need 5 years or 10 years? Well, different people have different needs for different times. Let's say, for example, you've got a very large purchase, like a car or a boat or something like that. And you need to have protection for yourself during the period of time where you're paying that off. That's why you'd need one of those. In addition, as soon as you have a life insurance policy, you protect what's called your insurability. You protect your ability to get insurance and maintain insurance. Some of those shorter term policies are renewable. So let's say you've had it for 5 years, then they offer you a renewable option. You can go ahead and renew it again. Many policies do that. Now, other policies such as a 20 or 30-year policy, those are the ones we normally buy because we've got big expenses like our mortgage, like we previously mentioned. Again, those are fixed, and some of them are renewable, but after 30 years, that premium is going to be substantially higher. Probably unaffordable, and maybe even not necessary at that time. Level premium. So this is important for people, particularly working with a budget. And a lot of the work that we do and that I do in financial plans is working with those monthly expenses. And a lot of times when people are starting out or younger, they really need that bang for their buck in the term insurance, and they're trying to work with a budget. And they offer what's called a conversion privilege to a permanent policy later. Now, what that means is people that buy a term policy, like I said before, maybe cash short in the earlier years, but then they have a need for insurance permanently later. And they could take advantage of a permanent policy by converting it. The benefit is that you maintain your health when you applied for the term policy. The only difference is when you get that permanent policy later on, years from when you first bought the term, you would then apply on your new attained age. So let's say you get it 15 years down the road. You upgrade or you convert to a permanent policy. You're now converting at 15 years later in age, but you're still maintaining your previous health. I don't know about you, but I've gotten heavier as the years have gone by, and probably not as healthy as I was, 15 years ago. So that's one thing to consider. And there's some non-medical underwriting options, and this is important for people that are afraid to have blood drawn or have a medical doctor do the underwriting for them. You do pay a little bit more money, but if that's a concern for you, then you have that option as well. And then on to permanent insurance. All right, coverage is for your whole life. And that's why it's got that name. A lot of people just say term insurance or whole life insurance, because permanent insurance, you've got it for your whole life. It's a much higher price than term, but it builds cash value. And the cash value grows from either interest, dividend, or market-based variable growth. Permanent insurance offers a living benefit with access to tax-advantaged cash. So that's what's unique about permanent policies. You don't have to die to get the benefit. Obviously, term insurance, you don't get the benefit. Your family gets the benefit if you die. Permanent insurance offers you a living benefit because you have access to the cash accumulation. In addition to the cash accumulation, there's many other living benefits such as insurance riders like long-term care and disability options, such as, let's say, a disability option would be not only in case you can't work, but also some types of options give you, in case you can't work, it pays the premium for you. And then if you pass away, your family would still receive that death benefit. Each policy is different, and each company will have a breakdown for you. And again, your Apella advisor will be able to review that with you when we make a decision. Some policies have flexible options. And as I mentioned before, the universal policy is the one that's flexible. So that means that not only is the death benefit flexible, but also the premium amount is flexible. And that may be later on the road where you need to make some changes. Let's face it, because in our life, we don't always have fixed expenses. Times can change, things can change in your life that will have a greater expense or a lesser expense. And it's nice to have the opportunity to be able to change how much you're paying for your premium in a life policy, particularly one that you have forever. All right, here we're going to give a comparison between term policies and permanent policies, their characteristics a little bit more. So on premiums, term policies have level premiums for the term of the policy. When a policy's up, there's no more premium on the term. Permanent policy, though, you're going to pay that permanently, and you've got a choice of level or flexible. Again, flexible is going to happen in the universal life type of policy. On cash value, term policies do not have any cash value. Permanent policies do, though. Loans and withdrawals. Now, there's no cash in a term policy, so there's no loan and withdrawal. In a permanent policy, yes. And again, that's where you're going to rely on your Apella advisor to help you make those decisions, because the way that you take money out of those policies is going to affect the tax treatment. Coverage. Well, as we mentioned, there's a defined number of years in term policies. 10, 20, and 30 are just some examples. Permanent policy, it's for your whole life. And the cash value investment risk. Well, term, again, there's no cash, there's no risk. But in permanent policies, there's different types. So in fixed type of policies, there is no risk because it's a fixed rate. It's more of a modest return, if you will. Variable, there is risk, however, because what does variable mean? It's getting some market performance. And we know the market goes up and the market can go down. And what are these two different policies used for? Well, term policies, income replacement is probably the most common. Permanent can be used for income replacement as well, but also, as we keep on saying, there's that tax-free or tax-advantaged cash accumulation and estate planning, as we'll get into later. So I really thought it was important to show people, for some who don't have life insurance or considering getting life insurance, what some types of premiums would look like, and particularly for a middle-aged person. 50-year-old non-smoker of standard health and a $500,000 death benefit. So I went out and I got a number of quotes from different companies, and I've taken kind of a ballpark average of them all. So first we're taking a look at a 30 term for a male, $3,100 per year. And for females, well, guys, unfortunately for us, girls have a better price for their life insurance because, well, they live longer than we do. So that means they've got a lesser premium amount. The underwriters of life insurance like that. $2,100 per year. So again, both 50-year-old, non-smoker, standard health, $500,000 death benefit. Difference here is just male versus female. Now we'll take a look at the premium for a permanent policy. As I said, it's substantially higher. Whole life, $13,200 for a male, a lot more money, obviously. But look at the cash value here, $696,000. Again, I took this straight off of a life insurance policy, and we can see that that's a substantial amount of money. So if it makes sense for you, we can even plan with you to do this more, not only just because you have a death benefit or a death benefit need, need for life insurance, I should say, but because of this access to your cash accumulation. If we do this correctly, you can even access that tax-free. Females, well, you're going to have less of a premium, but still look at this, a nice amount of cash value accumulation there. When we're talking about these types of policies, really, folks, we're really considering not just about the premium that you're paying. We're thinking about the benefit. All right, so that's one thing to keep in mind. It's a different thought process for these types of policies. So the three things to remember are that cash value from life insurance is tax advantaged. So as we were discussing, the strategies that we use that you'll work with your Apella advisor, you'll be able to figure out the best way to grow the money and also then access it income tax free by using policy loans. Some call this type of strategy a rich man's Roth. And the reason is because it's not really limited to how much you can contribute to these policies, and particularly with the universal type, which are flexible. And also, there's no income limits. So no limit on how much you can contribute and no limit on your income. Secondly, the death benefit from life insurance is always income tax free, and that can't be overstated. Obviously, that's the number one thing we think about life insurance is the death benefit, the amount that you get. That's income tax free. Number three, leverage life insurance to reach your goals. So how do I leverage life insurance? Well, this is where we have to put our thinking caps on. This is where we get into the heavy lifting. This is the strategic life insurance. This is how we at Apella work with our clients to figure out the best scenarios for them to maximize the most money for them and to keep the most money in their pockets or in their family's pockets. Charitable gifting, estate planning, and generational planning. First off, we're going to talk about charitable gifting. Now, many people have a charity or a nonprofit or a religious organization, something they give money to. And that's great, particularly as it can reduce our tax exposure. But right here, we're going to talk about you being the donor and giving to a charity and receiving a tax deduction. That's what we do. It's pretty basic. But if we add one more step and we implement an insurance policy, you also become the insured. So you are the insured and the donor. You make an agreement with your charity to say, listen, I'm going to continue to give the same amount of money I've been giving. But instead of you keeping that money, you put the money into a policy, a life insurance policy. When I die, you'll get the death benefit from that life insurance policy, tax-free. So the charity is incentivized to pay the premium in the policy. All you have to do is get the insurance written on you. You make the agreement with the charity. And of course, you'll have Apella with you to do that. And then you'll still receive the same tax deduction. Let's say, for example, you were donating $100 a week to a charity. That's $5,200 if you multiply that times 52 weeks. That's about $5,000 a year. Let's just round it down. So after 20 years, that's $100,000. Now, if you can use that same amount of money going towards a life insurance policy, the death benefit will be substantially higher. And from my experience and the examples I've had, and I've even have one in front of me here, that'll buy you about a $400,000 life insurance policy, given the same facts around 50 years old. So you can see how the charity would benefit from that, and you would benefit from that the same way with the same deduction. So that's how we would use a charity with life insurance. Estate planning. Estate planning is probably the most common of the three we're going to go over of the three that we're going to go over today. So we most commonly use a trust in estate planning, and the purpose is to protect the assets, protect your assets. A lot of times when we get older, sometimes our health is not as good, and we may have a health event where we have to be in a long-term care scenario. And many times, particularly in our older age when we don't have as much assets, it can drain our assets entirely. So if you still have a living spouse, they could end up destitute with no assets whatsoever. So what we do is we would put your assets in the trust. You establish the trust, the money goes into the trust. Also, though, you would previously had made this plan, and you would have previously put the life insurance, and the trust would be the owner of the life insurance. And let me tell you why. The reason is, if you have life insurance on yourself and then you die, the benefit of life insurance is tax-free, but the money that passes to your heirs, that is included in your estate, and then there's an estate tax. So when it's in the trust, it passes tax-free to the trust, and then since it's the trust has the money, it's not included into the estate tax of what's called the grantor. All right. So again, your money goes into the trust. The life insurance owns the trusts. Now, you had previously named a trustee. The trustee carries out all of your wishes. Made it sound a little funny there, but they do carry out all of your wishes. So that means you can manage your estate from the grave. And that's essentially what you do here with a trust. So there's many things that can be done there. I mean, it can protect your heirs from, obviously I said from estate tax. It can protect your kids from a spendthrift, if they're going to spend their inheritance. It also may protect, potential lawsuits and family disputes and even divorce. So, like I said, this is maybe more of a common one. It's still something that's complicated enough that an appellate advisor would be able to help you out with, and we're happy to do so. And lastly is Generational planning. This has become a real hot topic lately, and I'm really happy to show you this. I could probably do a whole presentation on these three, and particularly the stretch IRA, but I'm just going to give you a quick explanation today. Stretch IRA is not a product. It's not a thing that you buy. It's a method. It's a method that we use. And this is the simplest way to explain it here. Let's say, for example, Joe's is elderly, let's say, and Joe has an IRA and he's got a life insurance policy. Joe names his children the life insurance beneficiaries. Joe does not name his children the IRA beneficiaries. He names his grandchildren. Why? Because we stretch that to the next generation. And in so doing, you stretch the amount of time that the funds in the IRA have to grow. Because really, with time, compounding interest will substantially grow. And the reason why you do this also is because the rules of the inherited IRA or Benny IRA are that the beneficiary must take out the proceeds of that IRA over their lifetime. And clearly, the younger you are, well, not in every case, but the younger you are, the more time you have for those accounts to grow. So that creates a generational plan. Now, also, those funds are liquid. Those monies can be taken out pretty easily. So who wouldn't like to have some additional funds to be able to take care of their children? So Joe's children then would have the opportunity to take care of his children based on their parents' savings. Not to mention that Joe's children would have received the life insurance tax-free from their parents or from Joe. So that wouldn't affect their tax bracket, wouldn't affect their taxable income. So really, this is if your situation warrants it, and there was enough savings that you have, and again, we would have to review that for your individual case. This might be a really, really good way to not only leave a legacy, but a lasting legacy in this generational planning stretch IRA strategy. So our three main points. Common life insurance scenario. We mentioned it 10 to 20 times, but really got to do a life needs analysis. We'll help you with that. Secondly, there's two types of policies, folks. It's just term and permanent, and we'll figure out whichever one makes sense for you. Number three, completing the financial plan. We will show you how to leverage life insurance, how to get the most out of life insurance to keep more money in your pocket and keep more money in your family. And that's going to do it. So if we have any questions, I'll take them now. And I'll give you guys a couple minutes to see if there's somebody that's going to ask any questions. Well, anyway, we encourage you to consult your Apella advisor to find out if any of these strategies would fit your needs and financial goals. We certainly don't recommend trying to go out and solve any of these complex scenarios on your own. After all, this is an area where we're experts in. I hope this presentation helped you understand more about the uses of life insurance in financial planning and how it's just part of the value that we provide here at Apella. Contact your advisor directly, or you can use the general Apella email, info@apellacapital.com. You can also reach us on the phone here in our Glastonbury office. It's 860-785-2260. So let me see questions here. Okay, I've got one here. Can I get life insurance policy if I'm self-employed? Yes, of course. As I was mentioning before on the business side, I mean, there's many applications for getting life insurance if you own your own business. If you can't get it through work, and I mentioned controlling your own destiny. It's important that you do that. We will take a look at your needs analysis just like anyone else and figuring out how that fits into your plan. Particularly as you can use it even with some of the tax advantage saving strategies that we mentioned. So that's a very good question, and I would certainly encourage a review of that with us. Can I pay into a family member's life insurance? These are really good questions. Yes, you certainly can. Just because you don't have to be the owner of the policy and you don't have to be the payer. In a life insurance policy, there's different members of the contract. There's the insurance company. There's the insured. That's the person whose life it's based on. And there's the payer. The payer can be different than the owner or the insured. And also, there's the beneficiary. So those are the 4 aspects of a life insurance policy. Only thing you can't be is the insured and the beneficiary. All right. I think that's going to probably about do it for us. I really enjoyed this presentation today. Thank you for joining Apella Academy's continuing education webinar series. Again, my name is Jim Tavares, and this was Completing the Financial Plan with Life Insurance, brought to you by Apella Capital.